Hello there. Welcome back to Financial Accounting L5. In this video, we want to look at the preparation of the income statement of a partnership. So we're going to go through the question and then we answer the question that is on the preparation of the income statement. So our question is question one on that question paper, and it reads that the following information comes from the financial records of card-based traders with as card bearing pre-adjustment trial balance on 30 September 2015. So we are given that pre-adjustment trial balance, and I will see that these are the balances that we are having. So we can just go down trying to see what do we have in terms of the pre-adjustment trial balance. Then obviously we are not given the additional information that is beneath that trial balance. So we can just go through this information before you start to answer the question. So for the sake of this video, we are just going to just rush through and then you see the information. But in the exam, you need to read everything before you answer so that you can understand what is required. So, and also we have got a partnership agreement that we have here. We should also try to understand the relevance of a partnership agreement in a partnership. Remember, the partnership agreement is something that specifies the terms and conditions of how that partnership is going to be run in terms of the profit sharing ratios, interest and capital, and then in terms of the payment of salaries, monthly salaries and annual salaries. So and some other terms are mentioned in that partnership agreement. So it's a very vital document that is prepared before the partnership starts to operate. So in the event that the partners do not agree on anything and do not write in partnership agreement, it means the terms of the Partnership Act of 1890 has to apply. For example, if they didn't agree in terms of the profit sharing ratio, it means according to Partnership Act of 1890, they have to share the profits equally. So that will apply if they didn't agree on that. So this is what we have. So believe that as read as the remaining profits are shared in proportion to partners' capital contributions at the beginning of the year. So this is now where they are stating the profit sharing ratio that is going to be shared according to partners' capital contribution at the beginning of the year. So we will see the capital contribution there. That's what we're going to use in terms of sharing those profits. So on the required part 1.1, it reads income statement of card-based traders for the year ending 30 September 2015. So this question has got 42 marks. So for the sake of this video, we're only going to look at 1.1. So the second part of the current account, let's wait until the next video. We are going to bring you how to prepare the current account. So this is what we have. We can just try to go to our answer section and see our income statement that we want to fill in. So this is our income statement for the year ending 30 September 2015. So very important in terms of where the year is ending, we should take note of that. So in the income statement, we are now saying the first item that we are going to enter there is sales. And then from there, obviously, we will go to less cost of sales. So we can go to the question and try to see what figures do we have in terms of those two terms. We go there. So this is our pre-adjustment trial balance. That's where we're going to get our figures. So for sales, remember we are having it there. Let's just try to indicate it. We are here. That's where we've got our sales, and then the amount that we have is 1,202,400. So what happens is you are not supposed to pick it as it is and go and put it in the income statement. You are supposed to go through the additional information to see if there's anything that is affecting these sales. So you have to go through each and every additional information. So before you go to the additional information again, you check in the trial balance if there are any allowances in terms of data allowances or sales returns that can reduce the figure for sales. If they are inside the pre-adjustment trial balance, it means when you go to the other section, you are going to calculate it in brackets by subtracting the returns that you are given in the pre-adjustment trial balance. So in this case, we see that we have got no returns that we are seeing in this trial balance. So if we have such a scenario, it means you have to go to additional information to see if there are any adjustments that you think you can relate to sales that it needs to be adjusted, that you can adjust before you post that figure to the income statement. So obviously we go through each and every information until the end. So you'd see that according to this question, we do not have any thing that is mentioning about sales. So we can just take this figure as it is if it's that case. So we are going to take 1,202,400 and it's going to represent our sales. Then our cost of sales again, you see that we have given our cost of sales is 801,600. So it's already calculated cost of sales. Remember, in some questions, you might find that the figure for cost of sales you want given it as calculated as it is in this question. You will need to apply that formula beneath the heading of cost of sales in the income statement, whereby you say your opening stock, you add your purchases. If there are returns, you subtract your purchase returns. If there are carriages, you add your carriages, and then you subtract your closing stock. Then you find your figure for cost of sales. So in this case, it's already calculated, so it means we are going to deal with 801,600. So before you add again this 801,600, you go to additional information item by item, try to identify if there's anything that is affecting your cost of sales. But according to this video, you'd see that there's nothing that is affecting our cost of sales. So we are again going to take this figure as it is, which is 801,600. So basically, these are the two figures that we're going to start with, sales and beneath sales, we're going to fill in for our cost of sales. So we go there on the other section. Then for our sales, remember we got 1,202,400. Then cost of sales are 801,600. And obviously we are saying less, it means we subtract this figure. So what we are saying is if this figure you're not given it as in this question, this figure of cost of sales, you need to start by saying opening stock here. Then you say add purchases, then you less your closing stock there. And then the answer that you get, you're supposed to put it here as representing your cost of sales now. But in this case, you're not going to do that because it's already calculated. So after that, we go to other operating income. So here we are saying other operating income. So we go to our question to find other operating incomes that we can find. Remember, we can have a rent income, we can have commission received being our other income. So also in terms of trading stock surplus also we can fall under other income, and then a decrease in provision for bad debt adjustments can also fall under other income. So this is what we have. So those are the items that we are going to search for in the pre-adjustment trial balance. We go down searching for those. If you go down, so you'll see that we are not having, we're having rent income here, and the amount that we are given, the amount that is given in this pre-adjustment trial balance is here, which is 55,400. That's the amount for rent. So we can try to go through the additional information and try to see if we can find anything that is affecting our rent income. So we go through each and every additional information to try to find out if you've got anything that is affecting our rent income. So let's try to find out. So if you come here at this point, you would see that that's where it's mentioning about rent. So rent has got an adjustment that we have to make before we post it or enter it in the income statement. So it reads the rent increased by 200 rands on 1 July 2015. The tenant has paid the rent until the end of October 2015. So the first thing that we have here, let's start with this one. That is saying the tenant has paid the rent until end of October. So remember, our year is ending on, we can just go back and check where our year is ending. So if you come here, you'll see that our year is ending on 30 September 2015. And then if you go to the additional information of rent adjustments, we can see that we are being told that the tenant has paid until October, which is a month after the year end. So it means the rent that we are having there in the list of balances is for 12 months plus for October, which means we have got 13 months. So 13 months, we received 13 rent for 13 months. So which is inside the figure that we are given in the pre-adjustment trial balance. Then also the rent is being said to be have increased on 1 July 2015 by 200 rands. So we want to first count the months that the rent was increased. So starting from the July, so you're having July, the whole of July, then August, September, that's where the year is ending, and then October also it was received. So we have 1, 2, 3, 4 months when it had increased. So before that now, we are talking about the other months that we have that from the year when the year started until beginning of July. We want to see how many months are there. We can as well count that. Remember, our year is starting in our year is starting 1 October. That's when our year is starting. So we're saying October, November. We're seeing 2014, December, January, February, March, April, May, June. So May, June, and then 1st of July, rate was increased. So it was an increase for 1, 2, 3, 4, 5, 6, 7, 8, 9 for 9 months. It was an increase. So we can just formulate our formula from that basis. So what we are saying now is let's just try to put our formula there. We have got 9 months when it was increased. So let the rent be X. Let's just say it's X before it increased. So it was for 9 months. So we are saying 9 times X, we get the rent for 9 months. Then we don't know the rent, the amount of the monthly rent before it increased. Then after it increased now, it was now for 4 months. And the rent was now X plus the 200 that it increased with. And then if you work out this equation that we formed here, we are going to get the amount of rent that was received, that is in the pre-adjustment trial balance, which is our 55,400. So we are coming here and we are saying is equal to 55,400. So I think this now, we can just expand our equation by removing the brackets. We say 9x plus 4 times x there, you are going to get your 4x, and then 4 times 200, you are going to get your 800, and it's equal to 55,400. Then we can just correct like terms. We say 9 plus 4x, we get 13x. Here we are saying, here is a plus again. So we are saying, here we are saying 13x, and then we say plus 800 equal to 55,400. Then we can now say, take 800 the other side, it becomes 13x is equals to 55,400. And this positive 800 becomes negative 800 when it comes the other side. So this is what we have. And then we can say 18x is equals to, so let's say 55,400 minus 800. Let's just try to calculate that one. 55,400 minus 800. You are going to get your 54,600. So here we've got 54,600. Then from there now, we can now divide by 13 both sides, so that we can see the value of the rent before it increased. So 54,600 divided by 13. You're going to get your 4,200. So this is the rent before it increased. But the rent that we are looking for is the rent for October. That is outside our financial year. Our financial year is ending end of September 2015. So October is out of our financial year. Remember, according to the matching concept or the matching principle, we have to remove what doesn't belong to the current financial year that we are preparing that financial statement. So the rent for October that we received does not belong to this period. So we have to remove it out of the 55,400 that we received. So this one was before. So and then October was when the rent it increased. So after increase, the rent was now 4,200 plus 200, and you get your 4,400. So this is the figure for rent, for monthly rent after it increased. So it's going to apply again for October. So we're going to remove it from the 54,600. So that's how we are going to summarize it in the other section. So we come here. We say rent income. Here we are saying rent income. So we are saying here we're coming and say rent income, and in brackets we are saying 55,400 minus 4,400. And then the answer that we are getting is 51,000. So this is what we have. And then after that now, we go again to check if you've got any other income that we have there in the question. Remember, we are at rent income, so you see that that we don't have any other income. So after you see that we have exhausted everything in terms of the pre-adjustment trial balance, you go to the additional information again and go through everything in terms of trying to find out if there's any other income that you can see there. So let's go through each and every additional information and try to see if we have got any other income that is mentioned there. We see that on this page we don't have anything, so you can go to the next page. Try to find out if there's no any other income that we can include there. So let's try to find out. So having gone through, you see that we do not have any other income that we can see there. But before you go again, there are some items that can appear under other income, or they can appear under expenses that we need to check again before you leave the section of other income. We have got a provision for provision for bad debts adjustment. Provision for bad debt adjustment is something that we have to check again before you leave the other income section, because it can fall under the income, it can fall under other expenses, So remember, when it's an increase, it's an expense. You put it under expenses. But when it's a decrease, it's an income. So you have to check if it's an increase or a decrease before you leave the other income section. And also the other item that we can also check for is trading stock deficit or surplus. We know that if it's a surplus, it goes under other income. When it's a deficit, it goes under expense. So you have to check again before you leave that section. So those are the items that we can try to check before you leave the other income section. So provision for bad debts adjustment. Let's start by that one. Remember, we go to external information. That's where we get the instruction in terms of how to calculate it. In some questions, it will be calculated. So we are here. First of all, we are told that a data P print is disappeared, and this date must be written off as irrecoverable, 360. So this one is a credit loss, or we can call it a bad debt. So it's going to reduce the balance for data that we have. And then our next point is saying the provision for bad debts must be adjusted to 6% of the data. So we need to calculate this 6% and then compare it to the provision for bad debts for the previous year and identify if it's an increase or a decrease. So first of all, you have to remove this 360, which was written off. So we go to find the balance of data that we are given in the list of balances. You would see that data is here. We have given 52,060. This one, 52,060. So we are saying the rate that we are going to use is 6%. 6% as a decimal is 0.06. And then we multiply by the figure for data that we are given. Remember, it's here. Data control is 52,060. So we are saying 52,060. We subtract the figure for the credit loss or the data that is going to be written off of 360. We subtract 360. And then the net figure that we get there, we multiply by 0.06. So we can just try to calculate it as such. So when we calculate it, we are going to see that you are going to get 3,102. So here is the level of provision for bad debt for the current period. Then you compare it with the provision for bad debt for the previous period. That will be given in the trial balance. So the one that you are given here is representing of the previous period, which is 2,586. So we have 2,586, 2,586. So we identified the movement now. It's starting from 2,586 to 3,102. So we are seeing that there's an increase that is there. Then we can try to find out how much it's an increase by how much. We subtract 3,102 minus 2,586, and then we are going to get your 516. So it means there is an increase of 516. And this 516 is an increase. And remember what we said about increase and decreases of provision for bad debts adjustment. We indicated there that an increase is an expense. So we are going to put it under other expenses. And then this one we can delete when we reach the expenses section. So the other one is that's one that we want to check is the trading stocks deficit or surplus. So trading stock deficit or surplus, we are going to say the formula that we are going to use for trading stock deficit or surplus. Let's just maybe try to create some space. We are going to say book value minus physical stock count figure. If you get a positive figure, it means it's a deficit. If you get a negative figure, it means it's a surplus. And when it's a surplus, it's income. And when it's a deficit, it's expense. Something that we have to take note. So according to our question now, you see that the book value that you are given, you'll be given it in the trial balance. The book value is the figure that you are having in the trial balance, which is 98,480. But you can check in the trial formation if there's anything that is reducing that book value. But you'll see that we don't have anything that is reducing that book value. So we can just take it as it is, which is 98,480. So we are saying 98 is the book value, 98,480. And then we subtract physical stock figure is the one that will be given in the additional information, which is the following stock was on the end according to a physical stock taking on 30 September 2015, which is this one. You only take the one for trading stock, which is 96,930. Then you go there. 96,930. So you're saying 96,930. So you calculate it like that. I see that you're going to get 1,550. But here, the issue is we are getting a positive figure. So a positive figure is a deficit. So it's an expense. So this one is an expense again. So we're going to put it under expenses. So it means we have exhausted all the incomes. So in that case, we can go there and make our calculations. So we are now here. We are now taking this 51,000 as our total for operating income, and we transfer it there as our 51,000. And our operating income, we add them to our gross profit. Remember, here we are supposed to have our gross profit. Before other operating income, we are supposed to have our gross profit here. Gross profit. And for gross profit, we say sales minus cost of sales. So we are saying 1,202,000, 202,400 minus 801,600, and we are going to get your 400,000. So this is our gross profit, 400,800. So our other operating income, 51,000, we add it to 400,800 to get our figure here, which is 451,800. And this figure, we call it operating income. So this is what we have. Then we can now go on to check other expenses that we can see in the question. So we can go back and try to identify expenses that we are having in the question. So we can now go to our balances and try to find out expenses that we are given in the question. We go there. We go down, trying to find out. So you would see that we have a stationery. So stationery also, we also have to take note that the stationery figure that we are given there in the trial balance shows the stationery that was bought. The total stationery bought was 1,860. So out of the 1,860, we would want to see if there is stationery that is left at the end of the year. Because what we are going to consider as an expense is what was used during the year. So only to find out what was used, we can say what was bought and minus what is remaining at the end of the year. Then we get the one that was used. So that one would be the expense. So we go down to see what was left during the at the end of the year. Here we are seeing that we have got 200 as around stationery that was there at the end of the year. So to get what was used, we are now saying 1,800 minus 200. Then we get your one. Let's try to see. Stationery is 1,860. Here 1,860. That's our stationery. So we are saying 1,860 minus 200. So this is what we have. And remove this one. And then having presented it like that, it means our answer is equal to let's try to see. Is equal to 1,660. So that is the figure for stationery. So we can go there and summarize it as such. So if you go down, we are saying stationery. So in brackets, we are saying 1,860 minus 200. And then we are going to get your, we are putting in this column, then we say 1,660. So we go again to the list of our balances and try to find out other expenses that we are having. So beneath that, we've got water and electricity. We are seeing it. It's an expense 13,450. But before you put our water and electricity, we need to find out in additional information if you've got anything that is affecting our water and electricity. You go through everything. You go item by item, and also we've got our next page. You go item by item, trying to find out if we've got anything that is affecting water and electricity. So you'll see that we've got nothing that is affecting our water and electricity. So in that case, we take the figure that we are given there, 13,450, and it's going to represent our water and electricity. So go there. So here we are saying water. Water and electricity. And the figure that we have is 13,450. And then we go back. After water and electricity, we have got bad debts. Bad debts are the ones that include that one that we saw in the additional information. Here we've got 1,800. So in additional information, we've got something that was written off, if you still remember. Here we are here. Data. Pupils is disappeared and this date must be written off as irrecoverable 360. So it means we have got another bad debt that is there in the additional information. We are going to say the one that you are given here, 1,800, we add 360. So we go there and summarize as such. So we are saying bad debts. So we are saying 1,800, 1,800, and then we add 360. So if you calculate it like that, you're going to get your 2,160. You're going to get your 2,160. Then we go there, trying to find out any other expense that we have. Remember, we also have insurance here. which is 11,400. But we don't put it as it is. We go again at transformation to trying to find out if we have got anything to do insurance. We are having it here. An insurance premium of 9,840 was paid and recorded on 1 of November 2014. This policy expires on 31 October. So you see that this insurance is covering from 1 November 2014, which is within the year that we are preparing this financial statement. So you'd see that now, but it's overlapping into October, of which our year is ending end of September. End of September, that's where our year is ending. But this one is overlapped into October. So we've got one extra month that is being covered by this insurance of 9,840. So what are we going to do? We need to find out the insurance payment for October, and we can only find out about that one if we calculate the monthly one using this figure of 9,840. Remember, it's from 1 November 2014 to 31 October 2015. So there are 12 months that are there. So it means we can divide by 12 so that we can get the monthly insurance. So 9,840 divided by 12. So let's try to calculate that one. We are going to get your 820. So we have 820 here. So this 820 is also going to apply for October, which is outside our year. So we are going to remove it from the total of insurance that we are given in the list of balances. So if you go there, you'll see that the total of insurance that we are given there is 11,400. And you subtract the 820. So you come here, you say insurance, insurance, the figure that we are given in the list of balances is 11,400. Then you subtract your 820. And then you are going to get your 10,580 as the net balance. Then you go there and try to find out again about any other expense that we can have there. After insurance, we've got salaries and wages, which is 160,892. So we can go again and see information to see if we've got anything that is affecting our salaries. We check here, see that there's nothing. We go there and check again, and we see that there is nothing again. So we take the figure that we are given. We only have here, which we are going to deal with after this, which is saying Barry is entitled to a monthly salary of 1,400 more per month than that of a cut because of managerial duties. So this one, we are going to represent it alone separately. We are not going to mix it with the salaries and wages that we are given there, but it's also going to come under other expenses. So we are going to deal with it after this one. So let's just go and put this one as it is, which is we are having a figure of 160,892 in salaries and wages. So we can go there. Now we are saying salaries and wages. We are saying salaries. Salaries and wages, and the figure that we are given for salaries and wages is 160,892. So we can as well try to go to that one that is mentioning about salaries that we need to put here. So when we are given this under the partnership agreement, they are saying first one is saying CAD is entitled to an annual salary of 60,000. So whenever it says annual, you are supposed to adjust it in the appropriation. when it's a salary of a partner, but it's written as annual, you adjust it in the appropriation. But when it's a salary of a partner and it's written monthly, you are supposed to adjust it in the income statement under less expenses. So this is what we have. So this one, the second one B, we are going to adjust it there after this one in the income statement. So what is it saying? It is saying Barry is entitled to a monthly salary of 1,400 more per month than of CAD because of managerial duties. So what does it mean? It means we have to find the monthly salary of CAD and then we add 1,400. That's what we are going to do. So CAD is having 63,000 per year, which is annual. So per month is going to be 63,000. We divide by 12. So we try to find out when we divide by 12, what do we get? We are going to get 5,250. So this one, that is the one that is being said. Barry now is earning 1,400 more than this one. So we are adding 1,400. And then we get 6,650. So Barry is earning 6,650 per month. 6,750 per month. So to calculate the annual salary now for Barry, we now multiply 6,750 times 12. So if you multiply there, you will see that you are going to get your 79,800. So this is how we are going to, so we are just going to summarize the last working, which is this one, which is 6,750 times 12. So we go there. So we are here now. I will present it as salary, and it's for Barry. And we are saying 6,650. We multiply by 12, and we are getting 79,800. So 6,650, we can just maybe try to verify that one, the monthly, which is 6,650, correct? So this is what we have there. So after salaries and wages, we have got the one that is being said is salary for CAD. This one is CAD. Remember, for CAD is supposed to be adjusted in the appropriation. So for now, we can leave it. Then this is what we have. We can as well try to check in terms of other expenses that are not stated. In the trial balance, that we can only find in the additional information. Remember, we also have depreciation. We check for depreciation. So depreciation is, let's try to see. We have got depreciation here. 0.2. It's saying Barry increased this capital contribution by giving computer equipment valued at 15,000 to the business on 1 July 2015, which was during the year. This has been properly recorded. Depreciation for the year must be written off. Equipment at 10% of the cost price. So depreciation rate is 10%, and it's on cost, which means we're using the straight line method, which says percentage times cost. And but we are also told that there's new equipment that came during the year of 15,000. So this 15,000 is inside the figure that we are having for equipment in the trial balance, because the year is written that this has been properly recorded. So when we see the statement properly recorded, it means this figure that we are given is already in the figures that are in the trial balance. So what we are saying, let's go to the trial balance and take the figure that we have there for equipment. So for equipment, here we have got 108,000 here. So it means this 108,000, inside 108,000, there's 15,000 that came during the year. So we are saying 108,000 there's 15,000 inside there. So we subtract that 15,000 so that we calculate the depreciation separately. There we'll see what we get there, 108,000 minus 15,000. You're going to get your 93,000. So here, it means we have 93,000. So it means this equipment stayed for the whole year. And this one came during the year. So let's start by calculating the one that came during the year. And the rate, let's recheck the depreciation rate. Depreciation rate is 10% here. So the one that came during the year came on 1 July. So let's count the number of months that it said it was the whole of July, August, and September. Remember, the year is ending end of September, so it stayed only 3 months. So we're going to say times 3 over 12 after calculating the depreciation of 15,000. So our calculation is going to be 0.10, which is 10% as a decimal. We multiply by 15,000, the one that came during the year, and it stayed only 3 months, so we multiply by 3 over 12. So we try to calculate it as such, and we see that if we say 10% of 15,000, you get 1,500. Then you multiply by 3 over 12. You're going to get 375. So 375 is the depreciation for the equipment that came during the year. For the one that was said for the way is 93,000, so we're just going to say 0.10 times 93,000. And we are going to get your 9,300. Then we add the two, 375 plus 9,300. And we are going to get 9,675. So this is how we are going to summarize it there in the answer section as our depreciation. So here we are saying depreciation. So in brackets, we are saying 9,300. Then we add the 375. Then the answer that we are going to get is 9,675. So this is what we have. And then remember, we have got those two, provision for bad debts adjustments, and then the trading stock deficit that we already calculated. So we can just go and pick them. We have a provision for bad debts adjustment. We did calculate it, if you still remember. And we got 516. So we are just going to enter them. When we are in other income section, we are trying to find out if we are having for provision for bad debts, if an increase or decrease, and find out that it was an increase. So we have got provision for bad debts adjustment. And then on the calculation for that one, we said it increased to 3,000. The current year we found 3,102, and we subtracted for the previous year, which is 2,586. And it was an increase of 516. Then we also have provision for, we also have a trading stock deficit. Trading stock deficit, whereby we said the book value minus the physical stock count value. And we saw that the book value was greater than the physical stock count value. The book value was 98,480. And the physical stock count figure was 96,930. And we calculated and we got 1,550. So this is what we have. So we can try to find out if we've got any other expense that we are supposed to include there. Let's try to see if we have any other expense that we are supposed to include. We can always go to additional information and try to find out if we have got any other expense that we need to include. We can go to the partnership agreement and try to see if you have any other expense that fit in the in our income statement. Let's try to find out. So you would see that we also have another expense that is mentioned here, which is reads the loan from partner card was made on 1 April 2014. On 1 April 2015, 9,000 was repaid. No interest for the year has been paid. So the date that that the loan was made was 1 April 2014. It's outside, it's before our financial year that we are preparing this income statement started. Our financial year started on 1 October 2014. So we are not worried about what transpired before, but what we are only concerned with is that when the year started, the road was already acquired. So it's going to apply for the year. But then on 1 April 2015 is inside our financial year. That's when there was a repayment of 9,000. So it means the balance that we are given in the trial balance is the balance at the end on end of September 2015. So it means this 9,000 was already subtracted. So the figure that we are having there in the trial balance, which is for loan, which is 132,000, the 9,000 was already subtracted here. So we need to add the 132 back so that we know that at the beginning, what balance did we have? So we are saying 132. We are saying 132,000 plus 9,000. We are going to get 141,000. So it means at the beginning of the year, we had 141,000 loan. So we're going to calculate the interest there, and we see how many months did we had how many months we had 141,000 as loan is from 1 October to when the repayment took place on 1 April. So we have the whole of October, November, December, January, February, March, then April, 1 April, there was a repayment. So we have got 1, 2, 3, 4, 5, 6 months. So it was 6 months. We had 141,000 for 6 months. So we're going to calculate the interest for 6 months using 141,000. Then we calculate the remaining 6 months using the 132,000 after the repayment was made. So we go back to the question to check the percentage that is being used for the loan. Is there on the loan is 14%. So we come here, we say 14% at a decimal is 0.14. We multiply by 141, that is before the repayment, and it was for 6 months, which is 6/12. We do that, we see that the answer that we are supposed to get there is 9,870. That was the interest before repayment. Interest after repayment, now we are saying 0. We are now saying 0.14. We multiply by 132. That was after the repayment was made. 132,000. And also, we have got the remaining 6 months times 6/12. We calculate it as such. You see that the answer that we are going to get there is going to be 9,240. So to get total interest now, you add the two. To get the total interest for the year, you are now saying 9,870, which is this one before repayment, plus 9,204 to 9,240 interest after repayment. So we add the two. The total that you are supposed to get is 19,110. This is indicating the total interest for the year. So we are just going there and summarize as such. We go on the other section. So we are saying interest on loan, whereby we are saying our 9,870 plus 9,240. And we got the total of 19,110. So this is what we had. So you would see that these are the expenses that we have. We no longer have any other expense that we can include there. So we are just going to add so that we get the total for expenses. So we are starting from 19,110, which is at the bottom. We add our 1,550, add 516, add 9,720, 9,775, add 79,800, we add 160,892. We go up, we add 10,580, we add 2,160, we add 13,450, we add 1,660, and then we are supposed to get our total for expenses, which is our less operating expenses. So we skipped something there that we have to write there in between, just below operating income. We are supposed to say less operating expenses. Less operating, uh, less operating expenses was supposed to come here, and this figure is going to come here, indicating our operating expenses. It's going to come here. And if you add everything that is under our operating expenses, total that you are supposed to get here is going to be 299, 299,393. And we are saying less, so we are subtracting it from the figure for gross operating income. Basically, we are saying if we say operating income minus operating expenses, you are going to get your net profit. In the event that our operating income is greater than our expenses, we get a profit. But if our operating income is less than our operating expenses, we get a loss. So it will be a net loss. So if you subtract the 451,800 minus 299,393, you are supposed to get a positive figure, which is a net profit that we are supposed to put down here is 152,407, indicating your net profit. So this is your net profit. This indicates your net profit for the year. So we can close it, and then we can make a continuation in the next video in terms of making the appropriations and preparing the current account. Hopefully this video was helpful. Let's stay tuned for more videos to come. Let's subscribe and share. Let's share the link. Yes, for this video, I'm out. We'll meet again in the next video.